So that was the only change with FBT. The next area which had a few changes here that I'd like to take you through is in relation to capital gains tax. It covers a range of issues. So I'll start off with looking at the small business CGT concessions. And this will apply on sale of business from budget night, 7:30 Eastern Time on Tuesday. A couple of changes, not too major. We had good small business CG concessions for a number of years now. We had improvements to it. Now it's really just shaping up a few uncertainties. So one positive and one negative change. So it's pretty much tinkering around the edge as opposed to a major overhaul of the small business CG concessions. The negative one is really about trust structures, and I know that you have clients where they have multiple trusts. They're running business through companies and trust interposed structures, and this is to ensure that where the trusts are related, where the trusts are controlled, and in the past, because of the way the legislation drafted, they perhaps may not be captured as connected entities. The reason why we're interested in connected entities is really to meet the rules of, remember this concession is all about small business, and it's allowing small business with a market value, net asset value of less than $6 million. And in the past, before this proposed change, there are some trusts perhaps are not added on or captured as connected entities to be marked against the $6 million mark. So the change here is to, and we'll have to wait for the legislation to come through. The change is to make sure that if there are trusts that are perhaps related, they'll be captured and considered under the $6 million rule as well. So in a way, that will be a negative change, as we may have to include trusts that we didn't have to before as part of making sure that we are under the limit to allow us to have the small business concessions. On the other hand, the positive change is assets and trading assets or your business within the trust, and especially in interposed trusts. In the past, we have problems with trying to ensure that the business assets or the goodwill in the trust are active. Remember, under small business CG concessions, to be able to have the concession, then the asset that you're disposing of must be active, which means that it must be used in business. And in many cases where there are different structures involved and the ownership, then in cases where that applies, the assets themselves may not be active for this purpose. So again, we'll wait with anticipation of what the changes are to allow us for the assets to be active, perhaps which wasn't otherwise. So in terms of what you need to do and thinking about the impacts, is that obviously with a negative change, then some of your clients may be caught, and therefore they may just exceed the $6 million mark simply because the trusts that they had before were not caught previously and may be caught now. One thing which perhaps if we are pre-planning ahead, and that's one thing that I always emphasize, if you're looking at small business CGT, well, we should be planning ahead anyway. If someone is looking at retiring, have business for 5, 10, 15 years, is to obviously pre-plan the sale. And in doing that, we should be looking at, hey, look, if we sell the business in the next couple of years, what would be the impact, and pre-planning ahead. So under the new positive change, and a negative change as well too, we should be looking at, are we going to meet the conditions if we have connected entities, trusts, how would that impact us, and therefore we should accordingly restructure appropriately, awaiting the time when we would sell the business. So it is quite an important couple of changes there. If you're in the business of dealing with small business, self-employed, small business companies, and if you're thinking about selling the business, we do need to take that into consideration and pre-plan ahead. So I'll leave you with that to work out with your clients if they impact them. Now, other CGT amendments, 3 of them in effect that I'd like to take you through on this slide. The first one is about super funds. In the past, well, I still do get questions asked. I've got a super fund, and a member who's a trader, a share trader. So in the past, it would be the case that the super funds will be treated as a trader, and each of the stocks at the end of the year, or shares, for example, their investments will be considered as their trading stock, which means at the end of the year, if there are any losses as a result, and if I can remember back my accounting days, you would certainly work out then from your opening stock and the closing stocks, and the difference would be obviously flowing through your profit or the loss. And if that was the case, then if your shares were considered as your trading stock, you would include it in that formula, and as a result, if it amounts to losses, then the losses would be then deductible against whatever income you've got. That is in contrast to if your shares are considered as capital gains stocks, you would not include that in the stocks. So from 7:30 budget night, super funds will then take all shares and all investments as capital gains stocks as opposed to trading stocks. So that would resolve the issue of me having to answer a lot of questions in relation to that area. So for those of your clients where they're traders, this would be an impact that you need to consider with them. Moving on to the next one, testamentary trusts. It's a confirmation that distribution of asset will not result in a CGT event. We've always knew that. And we've always preached that. This is certainly to legislate to ensure it reflects the. It is a practice of the ATO. It confirms, it legislates what I've been saying as well too, which is good. Testamentary trusts and against all other benefits, the distribution of the assets will not result in a CGT event. So that's another plus for testamentary trusts. Now, what about deceased estate concession? Now, in the past, again, before this proposed change, one would always have the two-year period in terms of the disposal of the deceased estate. So if you're dealing with a deceased estate and you've got a principal residence in the estate, primarily you would tell the executor to dispose of within 2 years, and that would then not be any CGT on it. What this new change is allowing us to do is for the ATO to provide discretion, whereby if we do need to dispose of outside the 2-year period, that the discretion can be applied for to ensure that the CGT-free exemption continues to apply. So with this one here, what I would say is let's look at testamentary trusts, and I've said that many times. And this is estate as well planning. Estate planning, they're maintaining their good tax concessions, as well supported by the legislation that we can see. Estate planning is an absolute important consideration in intergenerational transfers. We have got clients that are aging. We have got clients in the elderly group. Certainly, we do need to do quite a bit of planning in this testamentary trust and this estate arena. So bear this in mind when you consider your clients' estate plans. Now, SDT, Special Disability Trusts, for those of you who have set these trusts up, you would know that there are Centrelink advantages in doing so. There are a number of conditions to set up SDTs, but they may be relevant for some of your clients. And this is really providing a couple of comfort in terms of a couple of issues in relation to SDTs. And the change that they're proposing here would apply retrospectively back to 1st of July 2006, and it's simply because that was when SDT were first set up as well under the current rules. So it does provide for a CGT exemption for assets transferred into trust, but for no consideration. So if you do have a client that falls into this category, for example, there might be a family member with severe disability, then the SDT trust could be set up, and perhaps the dad transfers in assets from his name personally into the SDT trust for the benefit of the severely disabled child. Then there will be an exemption for the assets being transferred from him into the trust itself. The other exemption that's available is obviously the main residence, very similar in line with what we usually would deal with as far as main residence is concerned in an estate, CGT exemption for estate on disposing of main residence within 2 years of death. In terms of consideration, given the sampling advantages there and the changes, which is really supporting obviously setting up trusts for severely disabled, and I guess there are concessions available from the Centrelink point of view in terms of gifting and the allowances, then for the right clients, then perhaps one should consider if this will be appropriate. But as I said, the conditions are pretty stringent. There are a number of conditions that needs to be met before the STD could be set up. But I'll leave you with a couple of exemptions there, which are concessions that apply in relation to this area.